All right, everyone, welcome in. We're really excited for another Markets and Economy update episode today. We've got lots of goodies to talk about with global trade and Strait of Hormuz. We're going to talk about AI and how it's impacting investments, and also how investments are doing so far now that we're a decent chunk of the way through the year. So we'll go ahead and introduce ourselves in case this is your first time joining us. I'm Jarrod Musick. I'm the CEO here at Destiny Capital, and I sit on the investment committee along with Tim Doyle. And Tim.
Yeah, thanks, Jared. Yep, my name is Tim Doyle. I am the Chief Investment Officer here at Destiny Capital, where I lead our investment committee, where we oversee quite a bit, including capital market research. We do manager selection, fund due diligence, portfolio construction, trading, rebalancing, and I work very closely with Jared and our client service teams in executing the investment policy statements for our investors. And periodically, I get to hop on webinars like this and write a blog every month. So I'm excited to be here. Yeah, we've got a lot of interesting stuff to cover this month. It's been a fascinating start to the year and a lot of interesting developments to talk about.
Yeah, absolutely. And just as a little primer here on the screen that you're seeing, so internally we operate on what we call our personal wealth operating system. So whenever we're working with client families, we really focus on these pillars that are listed. So get clear. We always want to make sure that strategies are tied to the things that you and your family want, the objectives that are really important to you, and how you want to use your wealth. Grow wealth is obviously what we're talking about today. So very investment focused, but also cost of capital, utilization of debt, evaluating trade-offs. Those things all kind of fit under that grow wealth pillar. Minimize risk is something else that we look at. So risk always shows up inside investment decision making. We will touch on that in a few areas today. But on the personal level, that's always estate planning, legal risk, insurance, different things like that. Looking for those showstoppers in the financial life. And then optimize equity if you're a business owner. How does your business equity tie in with everything else that you're doing? That should be a part of your investment strategy, part of your investment plan. That's something that we work heavily with our clients on. And then all of this is intended to maximize life. So spending time with the people you care about, doing the things that you like. That's really just a quick overview of how we look at the world. So we're going to dive in heavily on the grow wealth side today. So little conflict that, we've all heard about just a few times going on over in Iran. It sounds like maybe a double blockade of the Strait of Hormuz right now. Iran saying we're going to blockade it, and the U.S. says no, we will do it too. No, we're doing it. We're doing it. So there's not a lot of shipping volume going through the strait, I think, as we all know. Tim, what is that looking like it's impacting in terms of inflation and some of these other products that we really rely on globally that flow through that choke point?
Yeah, it's problematic. For those of you who joined us last month, this chart probably looks very familiar. Most of it is identical to what we covered last month, but I've included some new charts and some new data points that I wanted to cover. Not much has really changed. The truth is, not much has changed relative to the war in Iran. We've seen kind of a ceasefire as it relates to military action, a few skirmishes here and there, maybe in Lebanon and stuff like that, but relatively speaking, it's been somewhat quiet militarily, but we still have the problem factor, which is the Strait of Hormuz remains closed. And as we talked about last month, the Strait of Hormuz is a choke point between southern Iran and northern Oman, essentially, and it is a vital stretch for the transportation of key commodities being fuel, which we talked about last month in detail. About 20% of the global oil supply moves through the Strait of Hormuz each day. At the beginning of this conflict earlier this year, oil prices per barrel were around $60 per barrel. And if you look at the chart to the right, bottom right, where we have Brent oil prices, you can see that's hovering around $110 per barrel. That fluctuates obviously day in and day out, but a steep spike in oil prices, and we know that oil is the lifeblood of the global economy, so that's going to lead into higher prices elsewhere. And then we also look at national gas prices, prices at the pump, and you see that in the chart to the bottom right as well, where we have the current average for regular unleaded gasoline at $4.30. So the last time we met and we talked, it was about $4 per gallon. So that's obviously a steep jump for energy all around. So oil prices and prices at the pump, we've seen steep inclines, and that's obviously problematic for higher prices elsewhere. And then one area we didn't really talk about last month, um, and one key essentially commodity that flows through the Strait of Hormuz as well is fertilizer. So about 20 to 30% of the global fertilizer exports move through the Strait of Hormuz, and that is shut down as well. So that is causing a lot of problems for farmers. So farmers can either not get the fertilizer they need for their crops, or they can't afford it. I read a study recently from a farm bureau that basically stated somewhere around 70 to 75% of farmers can't afford the fertilizer they need to apply to their crops this season. So, why does this matter? Why does higher fertilizer costs and why does higher energy costs? Why does this impact investors? Well, we see that lead into higher inflation overall. If we look at CPI and PCE, a headline CPI at that, headline CPI includes food and energy prices. So as food and energy prices go higher, we're going to see headline CPE and CPI, excuse me, and PCE move higher as well. And you can see that in the charts at the bottom left side of the page, where we have quarterly annualized percent change for CPI and PCE. And these numbers really jumped out at me. These are from the Cleveland Fed. And you can see Jarrod circled these, thank you, where you have headline CPI projected at 6.4% and headline PCE at around, what is that, 5.5, 5.6%.
Hmm.
That's about 3 percentage points higher than what we saw, a month ago for Q1 projections. So again, this isn't set in stone. This is essentially annualizing the quarterly change that we see. It's not the year-over-year change that we're used to seeing, but it's alarming nonetheless, showing that prices could potentially move higher if we don't see a change in energy prices, if we don't see the Strait of Hormuz open and see free flow of both energy, oil, gas, and fertilizer. We could see higher energy prices overall, as I said, and higher food costs, which is obviously very painful for U.S. citizens, as we all know, based on what we saw in 2022. So, Jarrod, anything else you would want to add to that perspective and some of that data there?
Yeah, I think just as we were talking about this conversation, shocker, Tim and I talk before we talk. It's just kind of what we do. But really just thinking about all of the knock-on effects that are not super transparent. I think when all of this kicked off, it's very easy to see like, hey, there's a lot of oil producing nations in that area. A lot of that oil comes out through super tankers that have to go through that very narrow choke point. This is a problem for energy prices. Well, you add in other things like fertilizer, petrochemical inputs for plastics, all of these other goods, and we have this very connected, very efficient global supply chain. And when you take one of these choke points and cut it off, you're going to see more impacts, and we're likely to see that in inflation. So I think that's a great call out, Tim, on the fertilizer prices in particular.
Yeah. And talk about knock-on effects of inflation. We're looking at interest rates. So if inflation moves higher, it's going to be hard for the Fed to cut interest rates. Let's just put it that way. So if anything, I would think it would indicate that interest rates could move higher, in the year ahead, if we see inflation, kind of get untethered from that 2% target. So yeah, these
Yep.
knock-on effects are real and something that we're watching closely.
Yep. Okay. Well, as we move to the next slide, not inflation, but also lots of change happening here. AI continues to heat up. Utilization continues to increase, and I think we're seeing the greater depth at which, at least at an enterprise level, AI agents and some of these persistent workflows can really start to do some very, very complex tasks that have always been the domain of, high skilled white collar human employees. So, Tim, do you want to kind of talk us through what we're seeing in terms of software as a service, SaaS companies, and what we're seeing in terms of capabilities of AI right now?
Yeah, it's been really interesting, and I'm sure this has been all over the news. So I thought it was worth taking at least a slide here. This would probably be its own presentation where we talk about the software sector, AI, and kind of the knock-on effects we're seeing there. But it's been really fascinating. I think we were expecting coming into this year to see some AI disruption, right? We've seen these hyperscalers, the Metas, the Amazons, uh, oracles of the world investing heavily in AI infrastructure. And at some point, that infrastructure has to get put to use in use cases for corporations um, to either grow revenues, make them more profitable, make them more efficient, make them more, operationally effective. And we're starting to see the first glimpse of that disruption, I think, in the software sector. And the market reaction has been sharp. So, despite solid earnings that we've seen for many of these companies, major software companies in the US have sold off precipitously in 2026 as this, anticipation of disruption has permeated this particular sector. So we've seen companies like Salesforce down 31%, Adobe down 30% on a year-to-date basis, Workday down 43%, ServiceNow down close to 42%. Those are really big numbers and obviously alarming. So as a whole, we're seeing the software sector down significantly on a year-to-date basis. Even major players like Microsoft down, let's call it 12% on any given day. So major moves we're seeing there. So the question is, kind of what's happening and why.
Hmm.
And we're starting to see that AI disruption come into play. Uh, so we have to talk to kind of get into that. We want to talk a little bit about the pricing model for these software companies and some of the pressure that AI puts on that. So software as a service company, they often price their software and their services on a subscription basis. So it's recurring subscriptions. It's like your Netflix subscription. You're going to pay what $24 a month for your login for your seat, and this is on a often priced on a per user or per seat basis. So if you have 100 people and it's $100 a month, that's going to be $100 a month times 100 people. That's going to be what you pay this company for that particular software service. Uh, However, we're seeing that AI agents can increasingly and autonomously complete complex tasks that would take humans an extended period of time. So what this potentially allows companies to do is condense many seats, many software seats into one AI agent seat, essentially. Um, and the chart to the bottom right helps to kind of illustrate this a little bit. It's kind of the trajectory that AI has been on and the capabilities that have been that AI has essentially brought to the table for organizations where you have and you can see this is a hockey sticking of capabilities where essentially what we're showing are different iterations of AIs and chatbots and so forth and agents and the autonomous work that they can do in human minutes. So you see, starting in 2018 and moving into the early 2023s, you were looking at a couple minutes of human work that that this software could, or this AI could do. And then increasingly in 2025 and into 2026, we're seeing that move from maybe 10 minutes, 10 human minutes up to close to 70. And we anticipate that's just going to grow from there, meaning that AI can just do more and more autonomous, complex work and essentially compress the pricing model for these software as a service companies. So that's what investors are looking at. They're looking at this recurring revenue stream, shrinking of these seats that these companies price by, and therefore their valuations have come down. They're thinking, well, this company's not worth what it's going to be. The revenues generated now may not be there in the future. If anything, we anticipate smaller revenue growth, and that's problematic, right? That's something that investors are looking at. But essentially, when looking at software from an investor lens, right now, disruption is kind of turning into hysteria, where all software companies, regardless of product, financial health, projections, are being treated equally. So the sell-off is significant. We're seeing in private markets. We've seen that with some of the major players I talked about with Salesforce, Adobe, Workday. we're also seeing that in private markets, um, where I'm sure many of you, if you watch the financial news, have heard about troubles in private credit. They're worried about defaults in the software sector impacting the multi-trillion-dollar private credit market. And so where do you end up? To me, I think the truth is somewhere in between, where we have hysteria and then we have kind of reality, where there are likely going to be winners and losers here, but not all software companies are going to be going down due to AI. They are well aware of AI. They've been planning for it. They incorporate it into what they utilize, and how they build. And if anything, talking to some of these software investors, they like hyperscalers. They like what the hyperscalers are doing, because they're the ones investing their capex in AI and building out all of this infrastructure that they get to utilize. So they don't even have to dish out the funding to build this. They're just getting to utilize it and make it work for their organization as well. So I think we're just kind of in a transitionary time period that's really fascinating. But now more than ever, when you're investing in software, it's just important. Like investing in anything, you just have to ask key questions like, is the software mission critical for an enterprise? Is it easily commoditized? What competitive moats does it have around it? And what advantages does that software provider possess? And can they potentially move from a seat-based revenue model to more value-based pricing, right? So that's going to be kind of a transition that they'll have to go through. If the seat compression does happen, they're going to have to find another way to price their services, and ones that if the value is there, I think consumers and or enterprises will more than happily pay for that. So I know that's a lot. That's like drinking from a fire hose. There's a lot we could cover there. But Jarrod, anything else you would add to that?
Yeah, I think we're in this interesting place where we kind of have three buckets of people when it comes to experience with AI. So you have the first bucket, and those are people who've never used it, see no, reason to use it for them personally. And so they're getting all of their information just sort of through news and anecdotes from other people who do use it. And so it's very difficult to understand what the capability looks like if you just haven't touched it. The second kind are people who have probably gone in through a free version of ChatGPT and have used it as like an enhanced Google search. Like, hey, this got me a lot more information than Google. The results were more relevant to me. It's a really nice additional search feature, but I'm not going to pay for it, right? Like, I don't pay for Google. I'm not going to pay for this. And then you have the third bucket, which are people who are increasingly in fields where AI is becoming more and more useful and who are using these higher level models, which are subscription based. You're paying for it. You may be paying for additional compute credits on a marginal basis to do some of these more complex tasks. And those are the groups that are really leaning into this. So I think as an investor, whichever bucket you find yourself in, it's really important to understand that your own personal experience with AI is likely very different from lots of other investors' experience with AI. So when we look at repricing of software companies based on AI, that's probably a very large pool of investors that all have very different opinions about how this is going to work out. So I think from a professional perspective, if you're a Salesforce user, Salesforce, their main product is a CRM system. So it's really where all of your centralized knowledge about your clients of your business lives. You usually have lots of workflows, you have lots of stuff built on top of it. If you have Salesforce, it's a very expensive and very mission critical piece of technology that your team uses every day. We're, I think, not close to the point where somebody would say, I'm going to rebuild my Salesforce environment for my team of 100 in Claude and trust that it's going to do what I need it to do indefinitely going forward, right? So that company is probably not getting rid of Salesforce, but maybe the little frontier app that they have that a couple people on their team use a couple times a week, and it's helpful, but it's not a big deal. Those are the applications and the tools that are probably going away because you can build a workflow inside Claude in a half an hour that does the same thing in all likelihood. So I think it's going to be a very uneven set of outcomes for software companies based on how well they do about as you said, Tim, pulling AI into their environment and making their existing tools even more powerful and useful, versus other technologies that just don't provide as much value, and those may be sort of outcompeted here by AI in the next, call it 1 to 2 years. So, from an investor perspective, it's very fascinating to look at. We're going to get some very uneven outcomes here.
Yeah, yeah, very good points.
So again, from the investor hat, as we look broadly, we're not just talking about energy or fertilizer or AI or tech stocks. How have the markets done so far? What are we seeing in terms of health of the equity, the company side of the U.S. right now?
Yeah, I thought we can close on a positive. I know the previous slide can be a little bit disturbing. You see a sector down significantly. You see some major companies down 30-40% on a year-to-date basis. But fortunately, that market reaction hasn't permeated the broader markets, and we've seen, if anything, we've seen quite a turnaround in equities over the last call it 1 month. If you look back at late March, early April, just about every major asset class was a negative. It was a negative territory in a year-to-date basis. There was a lot of fear around what was going on in the war in Iran, energy prices, all the stuff that we talked about previously. But since then, we've kind of moved into earnings season, and earnings season has been really strong, which we'll get into in a minute. But if you look at the chart to the right, you can see how virtually every major equity asset class has rebounded sharply over the past month or so, with the S&P 500 surging about 14% from, let's call it March 30th through the end of April, into early May. So if you look at major index returns on a year-to-date basis, we've got the S&P 500 up 5.7%. We've got the Dow Jones Industrial Average up, let's call it 4%, just under 4%. The NASDAQ, tech-heavy NASDAQ, up about 7.2%. And then we've even gotten small caps into the game. It's been a bumpy ride for small caps for years, but it's been heartening to see small caps participating in some of this upside here, with the Russell 2000 up about 10.7% on a year-to-date basis, which is a really nice move for smaller corporations. They've been largely overdue for that. So that's been as an investor, that's been something we've been hoping to see for a while. But then you've got aggregate bond index. So you look at the Bloomberg U.S. Ag, it's virtually even. We've seen interest rates kind of fluctuate over time and even move higher as some uncertainty related to inflation has kicked in. And we had earlier in the year we had bonds up about 2 to 3% on a year-to-date basis. Since they've crawled back a little bit, and on any given day are plus or minus let's call it 1%. So bonds hanging in there, still providing kind of that steady Eddie ballast for portfolios. If not, really contributing to returns during times of volatility, they've held strong. So that's been, that's what we hope for from our bond allocations. So that's always good to see. But interest rate fluctuations are going to be problematic for bonds, and that's something we're watching closely to see where interest rates move from here. So why have markets moved higher? Well, we're about 30% of the way through earnings season for the S&P 500, and earnings are very strong. So far, we've got 84% of companies have beaten earnings estimates, while we've got 81% of companies that are reporting positive revenue surprises. So beating on the top and bottom line there at a healthy clip. We've seen very, very strong earnings growth, year-over-year earnings growth thus far. So the earnings growth rate for the S&P 500 is 15.1%. That's very strong. If that figure holds, and we're very early on, I expect that we'll stay in the double-digit range. Maybe this will move back down to let's call it 13.5% year-over-year earnings growth. But if this holds, it will mark the sixth consecutive quarter of double-digit earnings growth for the S&P 500 index, which again is great to see. Then we move to net profit margins. So profit margins again have been very strong, as they have been in previous quarters. Right now, the blended net profit margin for the S&P 500 is 13.4%. That's a very strong number as well. And if that holds, that will represent the highest net profit margin for the S&P 500 since the company FactSet, the data company FactSet, began tracking that data in 2009. And you can see that in the chart to the right, the bottom right, where you've got net profit margins over time. And we've kind of got that light blue shaded bar representing the current quarter. Again, we're very early into the quarter, more earnings to come, but we're off to a good start, and markets are reacting positively to that, and that's been really great to see, and welcoming for investors to see, major indices move into positive territory on a year-to-date basis,
Hmm.
and we're off to a, moving into this, the second quarter, we're off to a strong start.
Yeah, it's great to see that, we have volatility. We always
Yeah.
have volatility. We always will have volatility, and financial markets generally perform well over the longer time. So we're just looking at, close to a 4-month total time period here, and quite a big movement in markets over that time period. Just a reminder, if you're, currently a client of ours, we show S&P 500, Dow Jones, NASDAQ, Russell, US Ag Bond, right? Those are indexes just to give kind of a general idea about how is the market doing. So when we talk about fixed income, we use a lot of tools other than just, the Ag Bond index, right? There are a lot of very nuanced ways to do fixed income investing, along with all the different ways we do equity investing. So these are very broad-based indicators, and there's a lot more nuance inside your particular portfolio. So if you currently work with us and you have questions about that, reach out to your advisory team. We're happy to walk you through what you own and why. But just a little call out there because the bond returns, yeah, they've held in there, but I hope we're doing a little bit better than that on most of the bond holdings for our client families for sure.
Yeah, yeah. Just to add a little perspective for that, we believe for equity investing, we believe strongly in following indexes like the S&P 500, and we're nuanced within that as well. But we don't utilize, for the most part, active management. So stock picking, we don't utilize mutual funds that are actively managed. We tend to use low cost, highly efficient ETFs. However, for fixed income, we do think that active management can add value. So we tend to use actively managed funds for our fixed income allocations, and they tend over time to outperform an, an index like the Bloomberg U.S. Aggregate Bond Index. So yes, Jarrod, most of our actual bond holdings and how we invest in fixed income is outperforming that very baseline U.S. Aggregate Bond Index that you see
Yeah.
represented here. So I think that's a really good call out.
Yeah. And just the standard caveat, hey, past performance does not equal future returns. Everybody is individualized, all of those good things. So we're talking here in generalities about how markets are doing and how we tend to access them, but everybody looks
Yep,
a little bit different. So
exactly.
as we, head into the wrap up here, Tim, what would you like to leave our viewers with as the key takeaways from our conversation today?
Yeah, I think, when we talk about, the war in Iran, when we talk about AI and we talk about disruption, that could be somewhat unsettling. There are a lot of unknowns. It's hard to see around these corners, right? So that's when I always encourage our investors to lean into their planning. If they're looking for reassurance, talk to our team, talk about your portfolio, understand how you're allocated and how we purposely allocate to navigate these times of uncertainty. So you're not participating, you know, as we saw on the previous slide, just in what we see in the market returns there. Your return is going to be very nuanced and very specific to you. And we can help you understand that in a little bit more depth and give you a better understanding of that. And often that leads to reassurance. So if there is uncertainty, if there is any fear, if you're losing sleep at night due to concerns about anything that we talked about in the presentation today, please contact our team. That's why we're here. We can show you projections and how things look for your specific situation, and that's often helpful. It's helpful for me, and I imagine it's helpful for others. So I
Yeah.
think that's I could leave it there, and also encourage investors, if they have questions, please submit a question to our CIO mailbag. That's something I can address specifically, either to you directly, or I can address it in a webinar or a blog post separately for the Destiny Capital CIO mailbag. So that's always a good place to focus questions as well.
Yep. And you can get to that right through the homepage of our website,
Yep.
destinycapital.com. We always love feedback, questions, things that you want us to talk about in future episodes. So would always love that feedback. Well, I think we've covered a lot of ground today,
Mhm.
so we'll go ahead and leave you all with that. But we will have another episode of Markets and Economy coming up here in about a month. So, if you have anything that's really a burning question, don't hesitate to reach out to us. And we really value your time. Appreciate you spending some of it with us, and we'll be back again soon.
Yep. Thank you, everybody.